Well, good morning. I hope you had a good weekend. I'm Marlon Bowling with you. I appreciate you being with us. I want to bring in Brian Hoops of Midwest Market Solutions, and we'll talk about the market action and the setup for today's trade. Brian, hope you had a good weekend. What are you watching this morning?
Good morning, Marlon. Well, we can start talking about some of the unfortunate things here this morning, and that is wheat pushing to contract lows and that Chicago and the Kansas City contract. And part of it's a combination of, decent moisture across the winter wheat plains, but it's also news that Russia has lowered or basically eliminated its export tax for November 1st through the 7th. And of course, they are exporting as much wheat as they can at cheap prices so that they can fund their war. And this is another effort to lower prices even further, is eliminate that tax. So the wheat market took it on the defensive, trading lower overnight. That, along with just combined technical selling because we're at contract lows, moisture across the plains, and the lack of really any significant export business for the U.S. products is pressuring that market, dragging corn along with it. So if you now look at the corn market, we're just a nickel above the bottom end of the trading range. 2 weeks ago, we were pushing to the top end of the range, around 505 to 509. Now we're just hovering off of that 474 technical support area that is not very far from our harvest lows, just about a dime away.
Yeah, we're only one tick from the low of the evening trade. You have December 1 3/4 lower at 479 on these quotes provided by bar chart. So we were off of our evening high by about a nickel there. Looking at soybeans, we had November down 3/4, but I guess we need to start quoting January full time now, right? November goes into delivery.
Yeah, so actually that begins tonight. So the first notice day is tomorrow, but if you have long positions, you could be delivered upon after the close today. So really, this is the last day to be long November contracts, and almost everyone is now trading off the January or the March.
Okay, so we had January 3/4 higher at 1320 1/4. Now, if you move on to that wheat that you were talking about, if we look at Chicago wheat first, you had December 6.5 lower at 569. We have July. This would be your new crop for next year at 627 3/4. That's down 6 1/4 here this morning. But still, it's at a fairly steep premium to the nearby December contract. I mean, we're talking, almost 60 cents, I guess, premium for the new crop. Is that enticing or not?
Yeah, I think it is to a small extent. We probably will plant less acres this year, or we did this fall for the winter wheat contracts, and probably less spring wheat once again in the spring time frame. So our acres are going to be down overall. I think there is some interest in producers out there that if they've seeded some winter wheat, to look at those prices into the summer and look at the big premiums that they're holding to today's cash prices, and that makes it a little bit easier to go ahead and sell, even though we're at these lower levels or lower compared to the current price range. But just go ahead and make that sale, because it's unlikely we're going to meet that carry that's being out there or dangled out there for the producer to sell into.
So looking at Kansas City wheat, now here we were down 8 3/4 at 634 1/4, a full dime off of our overnight high there. And you have July new crop Kansas City wheat down 9 at 661 1/4. Now the spread is not as much between the nearby and the new crop months here in Kansas City. I mean, there it's not even quite 30 cents, but we're already on the nearby months at quite a bit of a premium to Chicago anyway. Is the weakness here just related to the moisture we've been getting here this weekend?
Well, yeah, that's a big part of it. The Russian export tax being lowered for another week is a big factor here as well. It just means that Russia is going to continue to sell more wheat into the world marketplace at cheaper and cheaper price levels. And the last few Egyptian tenders they have not been able to sell because they're trying to cap their price levels on the downside around 270. And there's other countries like Romania who are offering wheat cheaper into the world market. So this will help them gain some price advantage back by eliminating those taxes.
All right, let's look at Minneapolis wheat then and see what it's doing this morning. On the spring wheat, we had December down 7 cents. We're at 712 3/4. That would put us about 7 cents off of our overnight high, and goodness, within a penny of our low. Now in cotton this morning, as we get rolling this week, we have December, the new crop month, 66 higher. We're at 85.04 per pound. It's starting to come back just a little bit. It was very curious overnight on the energy markets with the war going on in the Middle East and things really expanding. One would think that would really support crude oil markets or energy markets. It did not. You have December West Texas crude down $1.22 at 84.32. Can you explain that one, Brian?
Yeah, well, we had a big, pretty big rally on Friday going into the weekend, fearing that there'd be more tensions and increase in the conflict, and really wasn't anything to speak of. So we were trading in a pretty broad range for that crude oil market. We're getting lower to the lower end of that boundary, testing that technical support this morning, or at least in the overnight we did. So Friday we tested the upper end of that trading range. Overnight we're testing the bottom end, and at some point the market will break out of it. And there's a lot of fear that it's going to break out to the upside, especially if Iran becomes really involved in this war in the Middle East.
How much do you think the end of the month will have to do with our ag trade today?
Well, I think especially in the cattle and the hog markets, we'll see a lot of positioning. The grain markets typically, because you not only have it's the end of the month, but you also have deliveries that we talked about earlier for the soy complex, especially for November futures. That usually you get a little bit of weakness going into it. We don't really expect to see any deliveries against November futures, so that'll limit how much positioning we see or how much movement we see because of the delivery period. But once you get past that, typically you get a rally in the grains when you get past delivery. And if weather in South America, now that we're getting close to 40 to 50% seeded in Brazil, now becomes even more of an important factor, and that could give us a lot of strength in the month of November.
Okay, we'll talk about that livestock trade in just a moment. We're talking with Brian Hoops. We'll be right back. All right, we're back with you talking with Brian Hoops. And Brian, let me look at the livestock summary from last week. It seemed like it took quite a while for the market to really get going, but when we look at how we finished up on the live cash cattle last week, from what I can gather, we had a range of about 183 to maybe 186. Now, some are calling it steady, some are calling, some of the trade a little weaker than the week before. But it really struggled, apparently, on the dress basis. The range, about 287 to 292, and I'm hearing that would be a fair amount lower than the previous week. Now, how does that compare to the sources that you work with?
Yeah, so it was a really interesting futures and cash market last week, Marlon. We started off the week with a gap lower following the cattle and feed report, and a lot of selling that took place Monday and Tuesday. And at that time, packers came in with very low bids, 180 to 181 in the Southern Plains, and the feedlots held out and passed on that for the most part until we got to the end of the week. And then packers started to raise those bids, 182, 183, 184, and we saw a lot of trade at 185 on Friday, and that is steady with the previous week. So it was kind of a real victory for the bulls in that respect. And the northern trade did trade at lower money, a couple dollars softer live, about $4 softer on a dress basis. And we've really seen a shift from the north to the south on a live basis. The summer, we were holding $8 to $9 premiums in the north. And now if you look at the cash trade, it's almost equal back to maybe more of a normal basis where the north and the southern trade is lined up. They're both in that 184 to 185 range. So this week, cash is called steady to higher again. The kills last week were almost identical to the previous week, 636,000 head. That's not outright bullish, but it is improvement over what we've seen earlier this fall when the packers had real negative margins to work with. Now they're maybe about $30 a head negative as the products are starting to improve. And so it leads us to think that the cash is going to be stronger here. Now, we had a big rally in the futures market on Friday. October goes off the board. October live cattle go off the board this week, leaving December at a pretty decent discount to that 184, 185 cash. So I have a feeling December is going to try and narrow that discount here early in the week.
Interesting. December was up 290 on Friday. We closed at 182.22. February was up 255. On the feeder cattle, this is how we closed as we headed into the weekend. You had November 40 higher at 236.90, and you had the January contract 62 higher at 235.70. Pretty wide ranges once again, almost $4 wide there. And on the lean hogs, I want to make sure I include this here as far as how we closed up last week. Very strong. December was up $1.85, and we finished at 70.47, so above that $70 benchmark. And we'll see if they can get any follow-through buying here this morning for confirmation or not. That'll be interesting to watch, too. Great stuff, Brian. Thanks for joining us today, and have a great week. That's Brian Hoops of Midwest Market Solutions.